So you are welcome to the part 4 of our group accounting. So in this video, we are going to be looking at the adjustment, the continuation of the adjustment. The part 3 looked at the purchase consideration. So we are going to now look at the remaining adjustments. Okay, so we are still on the examiner's streak. And we are still looking at the adjustment. The adjustments are what forms your footnotes, and that is what you will be doing to correct things in your financial statement to get it balanced. Now, we're going to continue with the next one. After our purchase consideration, we're going to look at mid-year acquisitions. Mid-year acquisitions. So if you check the question we just did in the part 3 video, you realize that they purchased it 1 year. You saw that. And what that thing did was that it made it so easier for you, especially your workings too. But sometimes you don't, the group structure that you design, you realize that the acquisition is somewhere 9 months. Okay. It's like post-acquisition is like 9 months or 6 months or 3 months or 7 months. It depends on the question. All right. Now, that is that. When it is 6 months, 9 months, they all goes into what we are talking about as what? Mid-year acquisition. Now, the key issues are that in consolidation, what we learn is that we assume evenly distribution of profit. That is the assumption. The normal assumption that is that we assume evenly distribution of profit. I'll explain that to you. Of profits. What does it mean? It means that if profit is 12,000 for the year, we assume that every month we divide it by 12 to say that every month it is what? 1,000. That is what it means. So if I now purchase this thing 6 months, it tells me that my post-acquisition and my pre-acquisition, so if I acquired it 6 months, then it means that my pre-acquisition will be what? 500, and my post-acquisition will be what? 500. So you realize that in your workings too, normally when you are doing retained earnings at acquisition date, if you remember, we have something like this: at acquisition reporting and what? Post-acquisition. So my advice to you is that anytime there is a mid-year acquisition, all right, instead of arranging the thing in this manner, in this direction, don't. Rather come this direction. All right. Please take note of what I'm advising you, because this is the tuition. And we've known how the examiner does these things. And when we are teaching like this, be very, very attentive and listen. Because like somebody asked, so say, why did we deduct? He joined late, that's why. But I wouldn't be honestly okay with it when I am saying it here and you are here. Then when we get to the computation, I put it there, then you now ask me, why are we doing it like that? At that point, you give me no no chance but to tell you that kindly go back to the video when I was saying it. Yeah. So please listen carefully. It's for your own good. All right. So anytime there is a media, so you could see that this one, you would have 500 cedis here. And I've already told you that as for your art reporting, you always pick it from the financial statement of the subsidiary side. So it will always be here. So I don't know, right now we don't have a figure here. But since you already know this side and you also know this side, you can calculate this side, all right, on your own. So that is how the evenly distribution rule says. Okay. However, when there is intra-group loan from the parent to the subsidiary at the acquisition date, it changes this this whole concept. So, however, if there is intra-group loan, and I will also explain it to you again, intra-group loan from the parent to the subsidiary. Anyway, you can only have a subsidiary when you acquire it. Okay, so this thing we are talking about is a post-acquisition thing. It's not a pre-acquisition thing. Pre-acquisition, there is no subsidiary. After you bought the company, you have the subsidiary. So please don't go and focus on pre-acquisition. You don't have a subsidiary in pre because you've not bought it. It makes like, it's as simple as that. All right. So, however, if there is intra-group loan from the parent to the subsidiary at acquisition date, the evenly distribution rule is distorted. Now, let me explain something to you. We are talking about consolidation. That is what we are doing. Now, so let me use, and I would need your contribution. Let me use marriage as an example, marriage. So because I'm a Christian and I believe that when two people marry, they become one. They are one. So when it's like they've consolidated. All right. Now, can you give yourself loan? And number two, can you charge interest on a loan you give yourself? In the first place, can you give yourself a loan? And can you charge interest also on such loans? Yes, I need your contribution on that. Can you give your wife loan? And
No.
can you charge interest on such loans? All right. So it's no. So if they give a loan, you cancel it out. Intra-group loan is canceled. So there shouldn't be anything like a loan between them. Now, I will explain to you why it's canceled and also the interest to why it shouldn't be. Okay, let's say they are even you can give your wife a loan and take interest. Now you come together. So when you come together, the loan you gave your wife is an investment to you. You've lent your wife money. So you have a receivable from your wife, right? Now, your wife has a payable. He has the same money to pay you, right? And then the umbrella of your surname is the family name. So that is the family. So when we combine the family, payables cancels receivables. Is that not it?
Yeah.
Yeah. So it doesn't exist. So again, the interest to you is an income, investment income. To your wife, it is a liability she has to pay. Under the umbrella of the family, it cancels out. Have you seen it? It cancels out. Now, if they gave a loan and the interest was inside their determination of the profit, what do? You will have to cancel the loan interest because it is inside their determination of profit. It shouldn't be there. It shouldn't be there. And mind you, when we say it was inside their determination of profit, they deducted it as a finance cost. So you need to add it back. So now, assuming that the profit of the subsidiary, okay, is, let's say, 10,000 cedis. And we tell you that included in that 10,000 in the profit, okay, was a 10% loan note interest. And the loan is, let's say, let's put the loan percentage to be like, let's put the loan to be like 4,000, okay, or 40,000. Let's do that. They gave a loan 40,000, and the interest of this loan is already included in the determination of this profit. So this is S, and the loan was given by the parent, when they bought it. They bought S on 1st July 2023. And you are giving the reporting date to be 31st December 2023. All right. So this profit for the year is 10,000. Already, you and I have established that per evenly distribution rule, we should be dividing this money. All right. So into 12 months, half. So pre will be 5,000, then post will be what? 5,000. So that is that. However, in the post, when they acquired them from July coming, they gave them a loan, and the interest is 10%, and that 10% interest has already been included in the profit of 10,000. What do? You have to take out that loan. You have to take out, the interest on the loan. You have to take it out, because it shouldn't be there. And I've explained to you why it shouldn't be there, because you can't give a loan to yourself. All right. As for a loan, it's a balance sheet item. So if you are doing a balance sheet, the loan too should cancel out. It shouldn't be there. All right. So now what do you do in this scenario? So what you do is that you add back the interest. You add it back. How much is the interest? And you need to be careful, because if they give the loan at this date, and this is the percentages on the loan, it's how many months? So it should be 10% of 40,000. And don't forget, percentage for loans are per annum. And here you acquired it 6 months to the reporting date. So you have to do 6 months. And 10% is 4,000. So 6 months, 6 will be what? 2,000. Please, is that understood? Hello, is that understood?
Yes, sir.
All right. Now you know the interest, and we've said that the interest should be added back. So now, what you do is that you add it back. So your 10,000, you add back the interest, because it shouldn't be there. It shouldn't have been deducted, because it's an intra-group. So 2,000, so that you get what? 12,000. Now, once you get your 12,000, you can now split it between the pre and the post. So our pre and post here will be what? 6,000. 6,000. Then you now deduct the interest from only the what? The post side. The post side. So you deduct the interest from the post side, which will make this side go 4,000, and here 6,000. So at the end of the day, you still have your 10,000 here. Your 10,000. All right, for the profit. So that is it. So if you were to do your workings too, you will start from your right hand side. You will start from here coming. You will first put the 4,000 for the post and put your reporting date and get your pray. Please, this statement that I'm making, please listen well. I know why I'm saying that. Listen and listen well. All right. So why are we doing this? Media. So that is all, Augustine. I told you that it is very important that when you are drawing your group structure, you put the period to the reporting date there. Another one, so this is for the media. The next, so this is what you see. A typical example is what you see here. All right, so I've explained it in your manual. All right, take note of that. Please, any question on the media? And please, when you are reading your consolidation question, be checking out for these things. Be looking out for them. All right. Any question before I move on to the next adjustment? All right. So I hope you grabbed this. The next adjustment is what we call uniform accounting policy. Number 3. Uniform accounting policy. Uniform accounting policy. All right. What is uniform accounting policy? It's simple. Now, when the parent acquired the subsidiary, probably the rule says that they should all use the same accounting policy. So let's say on depreciation, this one was using straight line, parent straight line, subsidiary reducing balance. They have to come together and use one policy. So changing someone's own to the other will bring out some adjustments, and all those adjustments are effected in your workings too. And I've already shown you how that thing works last week. All right, so both entities must have same accounting policy. In fact, if they don't have the same accounting policy, it will be very difficult to even consolidate. All right, so therefore, all changes must be done and adjusted in workings too. Anyway, this part of trick hasn't happened before in your exams. All right, so workings too. How do you do that? I mean, you know your workings too looks like at reporting. Oh, sorry, at acquisition. I don't know why I am not able to use this erase. All right, so what you normally have is at acquisition, at reporting, and post acquisition. That's your working too. So if there is any such uniform accounting adjustment, you drop it here. You drop it here. There's no. All right, you've seen that already. Then the fourth one I'm going to talk about is the fair value adjustment. We solved one last week. Fair value adjustment. All right, the fair value adjustment, you do remember, I've told you that the fair value adjustment is standard base. So the fair value adjustment can be a PPE. It can be on a PPE. It can be on inventory. It can be on receivables. And it can be on intangibles. Now, when you have such a situation, you know that you are going to adjust it also in your workings too. And you have the format for that from our last week's class. So you apply the applicable standards. Okay, the applicable standards. So this is where we tell you that take your standard serious. You apply the applicable standard. And most importantly, their initial measurement. So their initial measurement will be at acquisition. And their subsequent measurement effected in the reporting date. So now, for example, they will tell you that, oh, at the date of acquisition, you know that per acquisition accounting, IFRS 3, when you acquire, you should measure the net asset, okay? The asset. You see, you guys need to really appreciate principle and not just follow formalities. You need to appreciate principles. That thing we do, we call fair value of net asset. Yeah? We do, and we call it fair value of net asset. What does it mean? What is net asset? Net asset is your total asset minus your liabilities. That is what we call net asset. You need to understand this. And from acquisition accounting, we taught you that measure both the fair value of the asset and the liability at acquisition date. That is how you determine goodwill. That's why you do less fair value of net asset. If you don't understand or you think it's just a format you are following, that is it. Because I need to know your value, i.e. and you see, you've learned that asset is equal to what? A capital plus liability. Now, if you do A minus L, it is equal to C. And that is why when you are doing your workings too, you focus on your capital, the capital side of the subsidiary. That is the reason why. You don't need to go and pick their asset one by one and pick their liability one by one, because this side is set out for you. And that is the reason why you do that. Okay. Now, from your IFRS 3 acquisition accounting, it says number 1, identify the acquirer. Number 2, the net assets, both the liability and the asset and the liability should be measured at fair value date. So you use that one to find net asset. So that's why we focus here. We tell you to focus here on the side of the subsidiary. Okay. Now, if you are doing this, the asset should be at fair value. The liability should also be at fair value. Acquisition accounting. Now, in the exam, what the examiner tells you is that he tells you that at the date of acquisition, everything was at fair value, except then they will mention one item. We did one last week, if you remember, except a land. Now, when it is a land, which was not measured at fair value, it means that you have to go back and measure it at fair value. And that is why in your workings too, you will see fair value adjustment. So you bring it in. Since they didn't bring it when they were doing the acquisition, you will bring it in. You bring it. And you see, if it is land, so initial measurement, you have to bring the adjustment. So you put the amount there at acquisition. Then at reporting, it will still be there. It won't vanish. The asset will still be there. You see, that is for land. Now, you need to depreciate an asset, except that for land, we don't depreciate. But if there is impairment on that land by the time you go to the reporting date, you need to less the impairment. And on the friend of fair value adjustment, what? Impairment. If the thing is a plant, you bring the fair value adjustment, and the subsequent measurement, you will depreciate the plant. And when you are depreciating the plant, be careful. And be careful because, and this one I'll reference Augustine again. That is why I tell you to put the the period to the reporting date at that your workings one. Why? Because you see, it's not by force that when you buy a company today, you should consolidate it today. No. People can buy a company 4 years before they prepare a consolidated financial statement. Now, if you are now preparing the consolidated financial statement and you do your workings too, and there was a fair value, excess, over a carrying amount that wasn't considered, then you have brought the fair value in now. Then it means that the accumulated depreciation you have not charged since 4 years coming has to be charged. And that is why I need you to put that number of years or period in your workings one. If it is 6 months, it means the depreciation that you are doing, fair value adjustment depreciation that you are doing, will also be 6 months. If they bought it 7 months, it will be 7 months. If they bought it 3 years ago, it will be multiplied by 3. That fair value adjustment depreciation, multiplied by 3. That is why I need you guys to put those things there. Very, very important. Now, if it is inventory, you and I know that. So if it is inventory, you put it adjustment here. But you know that at reporting date, inventory is measured at the lower of cost and what? Net realizable value. That is the subsequent measurement. So anything you have to do to reduce this reporting date figure to the lower of cost and net realizable value will be the fair value adjustment. In this case, if it is inventory, it will be fair value adjustment, impairment of the inventory, so that you can reduce it to the lower one. If it is receivable, the same thing. IFRS 9, credit risk, bad debt, what you used to know in your SS. The subsequent one, you have to reduce it because there is a credit risk or there is a bad debt. Intangible, this is where it becomes serious. Intangible, you do well know that according to IAS 38, inherent intangibles are written off. So the fair value adjustment, therefore, will be, let's write it off. Let's write it off. That is intangible, inherent. But if it is not inherent and it is purchased, it is recognized. So that one, it will be at acquisition and at reporting. Now, you do well know that according to IAS 38, intangible asset with a finite useful life is what? Amortized. So you have to amortize it just as you do fair value adjustment depreciation. So this one, it will be fair value adjustment what? Amortization, so that you amortize the reporting date, and at post-acquisition, the total will be here. The movement from here, you put here. So you see, it is per each and every particular standard. They can even bring deferred taxation there too. So if you have a revaluation surplus that happen, then there is deferred taxation. You should consider the deferred taxation also. So please, this one, it is standard based. It is per each standard. And sometimes, you also know that intangible asset without a finite useful life is not amortized. So the examiner can give you that the thing has a remaining useful life of 5 years. However, the intangible asset is renewed indefinitely, which means that you don't know the finite useful life. So it means that you can't amortize it. You can't amortize it. You can only test for impairment. And if they don't give you the impairment, then it means that this side will be there, this side will be there. The subsequent measurement, there is no amortization, there is no what? Impairment. All because it is indefinite useful life. So please, though that fair value adjustment is standard based. Standard based. All right. So that is that. I will give you a question that has these things. You practice it. All right, so that is that. The next adjustment I want to focus on is post-acquisition revaluation. Post-acquisition revaluation. The word is post-acquisition revaluation. Post-acquisition revaluation surplus. Now, whenever there is a post-acquisition revaluation surplus, you do know that for every revaluation surplus, you debit the particular PPE and you credit your OCI. You know that. Okay, you credit your OCI. Now, the OCI has to be split into two. you are going to share it between the CI. So the CI part will be the CI percentage of the revaluation surplus, okay, which you will record in the balance sheet, SOFP group reserve. Please, I didn't say group retained earnings, I said group reserve. Then the NCI part, okay, will be the NCI percentage multiplied by that revaluation surplus, and that part will go to your NCI. So NCI, so this one, let's call this one workings 5B, okay, workings 5B. Your workings 5A is your group retained earnings, this one is group reserve. Then this one will go to your workings 4. So you see there's another element that can go to your workings 4, revaluation surplus, NCI share of revaluation surplus. Take note of that. All right, so that is that. That is that. The next one I want to also talk about is number 6, the intra-group transaction. I've already explained to you that intra-group transactions should be cancelled. Okay, I've already explained to you it should be cancelled because you are the same person. All right. So what do? You have to cancel them off. So cancel it. All right. So let's say they sold to one another, and it's in one of them is expecting the receivables. It's in receivables, the other one is payables. Please just deduct the figures from the receivables and the payables. All right. So you cancel them off. All right. So cancel them. Okay. So in your receivables, just do minus that intra-group transaction. All right. Okay. So then in the payables, to minus. That's all. However, there can be cash in transit, and there can be inventory in transit. Cash in transit, inventory in transit. All right. Now, what do you do? Now, the principle says that step 1, adjust the receiver's book to receive the cash or the inventory. So we said that whenever there is in transit item, treat the thing as if the person who was supposed to receive the thing has received it. So treat it, let him receive it. So you record the transaction as if he has received it. Then after he has received it, then you do the intra-group cancellation. All right. So so what I'm saying is that adjust the receiver's books. Whoever is supposed to receive it, the inventory or the cash, adjust their books to receive the cash or the inventory. So adjust their books to receive it. So let's say if there was a in-transit cash of 5,000, adjust it as if they will receive it. So let's say P paid 5,000 to S, but S has not received it because it is in transit. It hasn't cleared yet in his bank statement. What we are saying is that treat it as if S has received it. Because if P is paying, probably he was owing S. So treat it as if S will receive it. How do you do that? You will debit cash and credit what? The receivables in S's books. Now, once you credit the receivables and you debit the cash, the receivables now become at par, and therefore you cancel them out. All right, so that is that. That is that. So when you adjust it, then step 2 is what I just talked about. You do the cancellation of receivables. Cancellation of receivables and payables. Wow. Cancellation of receivables and payables. All right, take note of that. Okay, so that is that. That is that. That is that. All right. Then the seventh adjustment that you face is provision for unrealized profit, PAPs, and you saw it position inside your workings from last week's class. All right. So now the PAPs, how do you go around it? The PAPs, you have two types. We have PAPs inventory, and we have the PAP that is PPE transfer or sale. All right. So now the formula for obtaining your PAP, this one, is to do whether margin or markup. So let me start with the markup. Now, what is markup calculated on? On what do you calculate markup? Yes. So you need the markup percentage on what?
On cost.
On cost. On cost price. Of inventory still in stock, not the total inventory, but inventory still in stock. Still in stock at reporting date. All right. Then if it is margin 2, if they give you the margin 2, you do the margin percentage on what? On what do we calculate margin?
On selling price.
On selling price of inventory still in stock. At the reporting date. All right. Now watch this. This is what the examiner likes doing. Now, sometimes you have to convert margin to markup depending on the exam situation. So anyway, if you have 20% markup, converting the 20% markup to margin will be 20%, 20 over 120. All right. So please take note of that. If you have margin, converting margin, if you have margin of 20%, converting it to markup will be what? 20 over 20 over 80. 80. So that is that. So please watch that, because markup, if you are converting markup to margin, you add the percentage to the denominator. If you are converting margin to markup, you deduct from the denominator. All right, so that is the trick. I know you learned this thing in cost accounting in your senior high school. Now watch this. This is what the examiner will do. Now, if let's say subsidiary sells to parent, okay, when you want to determine the PAP and there are some inventory still in stock, when you want to determine the PAP for this statement, will you use markup or margin? Subsidiary sells to parent. Let's say they sell to parent 10,000 worth of inventory and it is still in stock. Will you need markup or margin to calculate the PAP? What will you need? For the subsidiary, the PAP for the subsidiary, will you need markup or margin? What do you need to be able to calculate the PAP? Markup or margin? Emmanuel, Rampa, Augustine, are you there?
Yeah.
Yes, sir.
Will you need markup or margin? Oh, guys, I need your answer.
So,
When it sells, then we use margin. When it's cost, then we use markup.
So this one, my question is, will you need markup or margin? You are not answering my question.
Okay.
So what is, but I've asked you a question. You are giving me when is this, when is that. You are not answering me.
Okay, you use margin.
You use margin. All right. Okay, so that's that. You use margin. For the subsidiary, you use margin when you want to calculate because he sold, the subsidiary sold. Selling means they did it at what? Selling price. They sold. So if I say sub sold to parent 10,000 and sub makes a markup of 20%, what will you do? What will you do?
You convert it into margin.
All right. So that is the trick the examiner does. So if S sells to P, if you are calculating the PAP for S, you should be using what? Margin, because he sold a selling price. Okay, if you were to calculate the PAP, now PAP is always calculated for the person who sold, all right? So that is that. And this one, since the subsidiary sold, it will be in your workings too. I know you know that. All right. Now, you see, selling goes with margin. You've seen that. And sometimes too, they can say that the parent bought. The parent bought. Okay. And when they buy, the person they buy from makes a markup of 20%. It's the same statement. So if the parent bought, then it means that the subsidiary sold. So always look at the positioning very well. Look at the statement very well. Whoever is selling needs a margin. Whoever is buying needs a markup, because to the person buying, it is cost price. You buy cost, you don't buy selling price. So please take note of that angle very well. So always check it, okay? So if parent sold to S, that one will be in your workings 5. All right, so it will be in your workings 5. So if you check the template of working 5 from last week's class, you will see it. So please take note and be very, very careful, okay? Be very, very careful. Read it and know who is selling and know whether they give us margin for the selling or markup. So if it is markup, then you have to convert it to margin. Now, if it is the person who bought, it is a cost, so you need a markup. So if it is that case and they give you a margin, then it means you have to also convert that margin to also a markup. All right, so that is that. So be very, very careful around that area. All right, so that is that. When it comes to the PAP inventory, what you're going to do is to actually find out. You see, it's a plant that they have sold, and plants or properties or whatever it is has useful life. They have useful life. So what you're going to do is that you need to find what we call the excess depreciation and treat them back. Now, so this is what you're going to do. This pen keeps freezing, so I'm going to use the manual that you bought so that I can move faster. Our time is even almost up. But please, all these videos are already on your page. Oh, they are already on your page. So please, after today, we are starting the intervention. So I don't need to come back and do the same thing again. Watch the videos, complete it. We will use the intervention to rather be solving questions. And I've sent you the questions. So please, the question, print them. Don't say you can't see from my screen. Print them and be holding them. All right. Okay, so what you're going to do is that, let me even use the manual to show you. So everything we are doing, it follows suit in your manual. If I were you, that's why you bought a book. We've done uniform accounting policy, we've done post-acquisition. And you see that each time I do one of them, you solve a full question with it and you learn. So you learn intra-group. After dealing with the intra-group, you have an example. Okay. All these things is there. All right. Now, what I wanted to show you is the PAP PP. This is it. PAP PP. Now, this is how it looks like. Okay. All right. So this is how your PAP PP looks like. All right. So you will do with transfer, without transfer. So you start with without transfer. If they don't transfer the asset to the subsidiary, it has its cost. It has its normal accumulated depreciation. This is their carrying amount. So if they transfer the carrying amount like this, so they will transfer at a profit. So you see there is a difference. We call it PAP adjustment. You see there is a difference. Without a transfer, they would have been depreciating it. And this person who now received it will also depreciate it. Then you have differences here. So you see, if the parents sold to the heirs, this one you see, the carrying amount that you see, will go and hit the retained earnings in your working file. So you see that template from last week's class. That is the reason. All right. Now, then the depreciation. Okay. So you have here the depreciation. So this is what I call the opening carrying amount. If P sold to S, that is where it is going as a debit, which means it's going to be a deduction. All right, take note of that. Then the depreciation, the excess depreciation, this one is going to workings 2 as a credit, which means it's going to be an addition. Take note of that. Then the closing carrying amount will also, the credit is going to your PPE, which is going to be a deduction. Sorry, PPE is a debit balance, so it's going to be a deduction. So deduction. Then the closing carrying amount. So let me put it right for you again. The opening carrying amount that you've done here is going to be a debit in your retained earnings, which means it's a deduction. The depreciation, the excess, this depreciation is going to hit your workings 2 as a credit. Workings 2. Then the closing carrying amount here will go to your SOFP against your PP. So please take note of that. If the subsidiary sold to the parent, it is the other way around. So the opening will be a debit, which is a deduction against. So whoever is selling to, whoever is doing the sale, the PAP is a deduction. All right. The opening carrying amount will be a deduction. Then, as usual, as for the depreciation, it goes against the other person. So group workings 5. So there it is going as a credit, so it will be an addition. Then the closing carrying amount, all the time, closing carrying amount is hitting your SOFP. Look at this illustration so that you understand it better. Look at this. If Daniel acquired 80% of O2 years ago, during Daniel transferred an item to O2, 60,000 in 2011. The asset originally cost 100,000 and useful life of 5 years for when it was purchased 3 years ago. The useful life of the asset has not changed as a means of the transfer. So it means that the thing had 5 years when they bought it at 100. 3 years they deducted 60. So the carrying amount is what? 40,000. Now this 40,000, they now transfer the thing to O2 at 60,000. So it means there is a difference here. Daniel being the parent means that this thing will go and be a debit at the workings 5. This one. Now, depreciation continues, is 2 years remaining. So if 1 year will be 20. Now it came here, 1 year on this will be 30. 30. So you see that the depreciation has moved from 20 to 30, which means the excess depreciation of what? 10,000. Yeah. The carrying amount, therefore, as you see. So since P sold to S, this one will be a deduction against workings 5. This one will be an addition in workings 2. And this one will be against your SOFP PP. So that is what you see there. Had it been that S had been the one who sold to P, this 20,000 will be a debit in workings 2. This 10,000 will be an addition in workings 5. And this one, a deduction also from on your SOFP. So that is how you do PP transfer. Okay, all right. I know you go over this because I'm going to give you a question that will have it. So go over it. All right. All right. So please watch the template well. Without transfer, with transfer, if they don't transfer it, you go through to do what you do. With the transfer, you also do continue with the depreciation, then the adjustment. All right. So the first one is in the books of the person who is doing the sale, and it is a deduction. The second one is going to the person who bought it, and it is an addition. The third one will be against your SOFPPP. All right, so that is that. That is that. Okay, so the last one that we want to talk about in terms of the tricks, then we end today's class, is intra-group dividend and interest. I think we've already spoken about that. So you see, everyone that you go ahead and do a trial question. You go and do. So please, honestly, I don't think you really have an excuse. You have to practice it. And thank God you have your manual. All right. So that is that. That is it for the PAP PP. Okay. And the PAP inventory. So the last one, which we've already dealt with anyway, is similar. We've done the intra-group interest, which you cancel out. So the last one will be dividend paid by the subsidiary. Now, if you come together and the subsidiary pays you dividend, you see, parent will receive it. So when the parent is receiving it, what does he do? In the parent's books, he has received a cash. So he will debit his cash. And what will he do? Credit his investment income in P&L. So this is what will happen. This is what will happen. Now, you see, the person you also bought, pay this thing out of cash. So for him to, he will credit his cash. He will credit his cash. And it's a dividend. So he will also debit his retained earnings. So that is it. He will debit retained earnings. And you also credit his cash. That is what they will do. But since you come together, this intra-group transaction will offset itself. So what we say is that intra-group dividend should be reversed. Should be reversed or cancelled. How do you do that? All you need to do is to debit the investment income. Once you debit the investment income, it will have effect inside the retained earnings. All right, so that is that. Okay. Now, sometimes they will tell you that the subsidiary pay dividend. Pay dividend. Now, they weren't specific that the dividend was paid to the parent, but you do well know that the parent owns a percentage in the subsidiary. So let's say if they own 60%, it means the part that they don't own is 40%. This is CI, this is NCI. So if the subsidiary paid dividend, then it means 60% of that dividend came to the parent, and that is the part that you reverse. All right. So that is that. That is that. So please be careful of that. Not the total dividend, because you didn't buy the entire company 100%. You bought 60%. So the part of the dividend that will be coming to you with the subsidiary as paid is going to be the CI part, which is 60%. So take note of that. Take note of that. All right. So you calculate it and you reverse it. You debit the investment income. All right. And you deduct the dividend from the profit after tax. All right. So take note of that, which is kind of the net profit and retained earnings. All right. So take note of that. If there is any intra-group transaction, I've already told you that for intra-group loans, you should cancel it. Any intra-group thing is canceled. So if there is a loan, you have to cancel it. How do you cancel a loan? You will cancel the loan by debiting the loan. So cancel it. The cancellation is by debiting the loan, which is NCL, and you will credit investment, which is what? NCA. All right. So ladies and gentlemen, this is it. All right. So that is that. So the thing left for us to do is to actually pick questions and practice all these 9 principles that we have actually studied. All right. So I've sent you some 3 questions on your platform, and I want you to try your hands before we try them together. Thank you very much.